Hello, everyone. Thank you so much for joining us again for another weekly wrap-up. My name is Jeremy Kronemeyer. I'm Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the market last week?
Yeah, thank you, Jeremy. Thank you for our listeners jumping on the call. We saw equities really rebound from a 3-week losing streak. We saw some pretty positive earnings because we started earnings season. At the same time, we saw some concerns about some inflation data, but they kind of bucked that with the great earnings that were reported. So we saw the Nasdaq rise about 4%, where we saw the S&P and the Russell 2000, that's the small caps, they both rose about, just say about 3%. We saw all 11 of the S&P sectors finishing higher, led by technology. Again, blowout numbers by Microsoft and Alphabet that kind of led that. At the same time, we did see crude oil rise about 2% as well. On the flip side, or the downside, we saw gold pull back just a little bit from its highs. We did see the U.S. Treasury yields surge on Thursday with those concerns with the PCE number that came out. That rose about 3.7% year over year, well above that 2% pace. So we're seeing some hotter inflation numbers out there, kind of spooking the market, spooking the anticipation of the Fed lowering interest rates. At the same time, we're seeing some things bubble up in terms of people talking about stagflation and the concerns of stagflation. You may be hearing that kind of bubbling up in conversations. I don't necessarily think we're there, but that is starting to be talked about. We did see some weaker growth overall, and that was attributed to maybe a surge in imports and a downturn in some government spending when we're looking at the gross domestic product numbers that came out. It came in about 1.6%, and I think the market was really looking about 2.4%, so that was a really big drop. Now, I think there's going to be some pretty good size revisions to that everyone's expecting. So we did have the U.S. Treasury Secretary Yellen come out and make some very clear statements that they're looking at some revisions higher for the GDP. But that was a big drop than what the market was expecting, hence, I guess, bringing up the statements of stagflation. So we did see a stall in disinflationary trends. It's likely to delay the Fed's or Federal Reserve's timeline in terms of potential interest rates being cut. We saw the PMI reading falling about to about 50.9. Now that was above the 50 level, and that level kind of separates growing or contracting in terms of the economy. So we'll be looking at orders for durable goods rose modestly in March. We did see U.S. housing market receive some pretty good news for the Q1 GDP report, where we saw some residential investments jump up about 13.9%, but still holding sales down a bit, even though they bounced with those higher rates, because we did see a pretty good pop in yields when we saw some hotter economic numbers. Now, if we go overseas, we saw the Bank of Japan keep its policy rate pretty steady. We go over to Europe. Europe and UK business activity was unexpectedly strong in April, bringing in some hopes that maybe they're going to start to see a return to growth in the regions. Germany sentiment indices were improving, but remained at some low levels. Now, this week is full of inflationary numbers, economic numbers, and earnings report. I think we have the busiest week of earnings this week. So we got some pretty heavy hitters coming out, like Apple and Amazon, which is tonight, Advanced Micro Devices, Super Microcomputer, Qualcomm. I mean, many, many more. We also have some U.S. economic data coming out. We'll be looking at the ISM PMI numbers. We'll be looking at those survey results for that, the consumer confidence numbers, and some preliminary Q1 productivity figures and factory orders. Keep in mind that we are also trying to be very mindful of the consumer. We are seeing the consumer savings rate starting to lower a bit. I think it was down about 3.5%, and their spending is up. Now, again, we would like their spending to still stay high, but not too high that they start not saving enough, right? We just got to be a little mindful of that. It's not overly concerning right now because we have relatively good gross domestic product, strong consumer, and I think the earnings picture is going to show up pretty strong this season. So those are all good numbers. It's just not helping the Fed probably lower the rates where the market would like to see right now. Jim?
Gotcha. Well, I had a question for you, Graham. So I know you mentioned all the economic numbers coming out and also all the kind of the still some earnings to come out for the big companies.
Mm-hmm.
Do you see the market staying pretty volatile around all the numbers and things like that going forward?
I do, and I think volatility is relative, right? A couple percent here or there, 3 to 5%. Could we get a bigger pullback than the 5% we just got through? Sure. I think you always have to kind of bake that into the cake. That's not unnormal. I don't think it would be unhealthy. I know we probably said this over and over again. It's not unhealthy to have the market kind of pause for a bit, digest, especially those sectors that have advanced so much. It was really led by technology. They dropped. They've been leaders again. So I think the market can move sideways down a bit before we set ourselves up for maybe third and fourth quarter, maybe getting closer to the Fed lowering interest rates if we see that at all this year.
Gotcha. Well, we always appreciate the information.
Yeah.
And again, to our listeners, we do have our retirement planning today classes starting next Tuesday, May 7th. So if you're interested in that, check out our website or call us here at the office. We'd be glad to give you more information on that. And we look forward to seeing you next week. Thank you so much.
Take care.